Your bank is legally allowed to steal your savings. Most people think the money in their bank account belongs to them. That is dead wrong. The moment you hand your hard-earned cash over to a teller or transfer it online, you no longer legally own that money. You just became an unsecured creditor. You gave the bank an interest-free loan. Under modern legal precedent and financial regulations, banks have mechanisms to keep it if things go south. It sounds like an insane conspiracy theory. It is not. It is the written law in almost every major economy across the globe. Today, you will learn the exact legal loopholes banks and governments use to seize, freeze, and erode your wealth. More importantly, you will learn the exact legal strategies to protect yourself, diversify your risk, and take back control of your financial destiny. Let us go back to the year 2008. During the great financial crisis, giant Wall Street banks made reckless bets. They blew up the global financial system. The government stepped in and used trillions of taxpayer dollars to rescue them. That was called a bailout. The public was furious. Voters demanded that taxpayers never foot the bill for bad banking decisions again. So, politicians and central bankers quietly changed the rules of the game. They introduced a legal framework called the bank bail-in. In a bail-in scenario, a failing bank does not look to the government for survival. It looks directly at its own depositors. When you deposit money into a traditional bank, you swap legal ownership of physical cash for an unsecured debt obligation. The bank owes you money, but they own the cash. If a bank faces insolvency, modern financial laws allow them to recapitalize their balance sheet using unsecured debt. That means your personal deposits can be legally converted into bank equity overnight. Look at what happened in Cyprus in 2013. Uninsured depositors woke up one morning to find their accounts completely frozen. Up to 47.5% of their life savings was forcibly converted into worthless bank stock. In the United States, Europe, Canada, and the United Kingdom, this exact framework is coded into law. Under Title II of the Dodd-Frank Act in the United States, major financial institutions have resolution plans that prioritize bail-ins over government rescues. If a systemic banking crisis hits tomorrow, the legal framework exists to lock your account, haircut your balance, and hand you worthless shares in a bankrupt financial institution. Many people assume they are completely safe because of government deposit insurance. In the United States, that is the FDIC. The FDIC claims to protect up to $250,000 per depositor, per institution. But look closely at the actual math. The Deposit Insurance Fund managed by the FDIC holds only a tiny fraction of total insured deposits in the banking system. Usually, that reserve ratio hovers around 1.2%. If one or two small regional banks fail, the FDIC can manage the claims easily. But if a systemic crisis hits multiple major banks at the same time, the fund gets depleted almost instantly. To honor those claims, the federal government would have to authorize massive money printing from the central bank. That brings us directly to the second legal method of wealth confiscation, silent inflationary decay. Even if your bank never freezes your account or forces a bail-in, your wealth is still being legally stolen every single day. Central banks operate under legal mandates that allow them to deliberately inflate the money supply. When central banks print trillions of dollars out of thin air, the total supply of currency expands dramatically. More currency chasing the same amount of goods and services causes prices to skyrocket. If your bank pays you 0.01% on your savings, and inflation runs at 5%, you lose almost 5% of your purchasing power every single year. Over 10 years, a savings account with low interest will lose nearly half of its real value. You did not spend the money. Nobody took dollars out of your account on paper. But your legal right to buy goods and services with that money was stripped away. It is a legal, invisible, compounding tax on financial loyalty. The danger does not end with banking collapses or central bank inflation. The legal system allows direct government and institutional seizure of your funds through civil asset forfeiture and automated compliance flags. Under civil asset forfeiture laws, law enforcement agencies can seize your cash, your vehicle, or your bank accounts without ever charging you with a crime. In traditional criminal law, you are innocent until proven guilty. In civil asset forfeiture, the lawsuit is filed against your property, not you. Your money is presumed guilty until you spend tens of thousands of dollars in legal fees to prove its innocence in court. At the same time, banks operate under strict regulatory frameworks like the Bank Secrecy Act and anti-money laundering mandates. Banks rely on automated algorithms to monitor every transaction you make. If you make cash deposits or withdrawals just under $10,000, the bank system flags you for structuring. Structuring is the legal term for intentionally breaking up financial transactions to avoid federal reporting thresholds. Even if your money comes from completely legitimate sources, the act of structuring itself is a federal crime. The government can freeze and forfeit your funds instantly. Furthermore, if you transfer money to a cryptocurrency platform, make an international payment to a relative, or engage in unusual buying activity, the algorithm can lock your account without human review. When your account gets frozen, the bank will not give you details. Employees are legally prohibited from telling you if a suspicious activity report was filed. You are left stranded without access to your own funds to pay your mortgage, buy groceries, or pay payroll for your business. The burden of proof falls entirely on you to navigate a bureaucratic nightmare. Understanding the threat is only the first step. You must know how to use the legal system to build an impenetrable financial fortress around your wealth. Here are the concrete, legal strategies you can implement right now to protect your assets. First, break up bank concentration risk. Never keep all your liquid capital in a single banking system or institutional brand. Spread your short-term operational cash across multiple non-affiliated banks. Combine large commercial banks with community banks and credit unions. Credit unions are member-owned, non-profit institutions. They operate under fundamentally different business models and risk structures than Wall Street megabanks. Second, maximize deposit insurance coverage through proper legal structuring. The $250,000 insurance limit applies per depositor, per institution, per ownership category. By using different legal ownership structures, you can multiply your protection. An individual account, a joint account with a spouse, and a revocable living trust account at the exact same bank each qualify for separate insurance limits. If you run a business, hold funds in distinct legal entities like limited liability companies rather than your personal name. Third, utilize domestic and offshore asset protection trusts. If you face high legal exposure from lawsuits, creditors, or aggressive claimants, holding assets in your personal name is dangerous. An asset protection trust is a legal structure designed specifically to hold assets outside the reach of future creditors. In states like Nevada, Delaware, South Dakota, and Wyoming, self-settled spendthrift trusts allow you to place assets into an irrevocable trust while remaining a beneficiary. Once assets are properly placed in a qualified trust, you no longer legally own them. If someone sues you personally, a judge cannot order you to hand over assets that belong to the trust. Fourth, exit paper currency and store wealth in hard, productive assets. Cash is designed for short-term transactions, not long-term wealth preservation. To beat inflation and dodge banking counterparty risk, limit your bank deposits to 3 to 6 months of expenses. Move the rest of your wealth into assets with physical utility and legal ownership title. Invest in physical real estate. Real estate provides rental income, tax depreciation benefits, and a tangible asset that cannot be wiped out by a banking software glitch. Hold physical precious metals like gold and silver. Store your physical bullion in secure, non-bank private vault facilities. Avoid holding precious metals inside bank safe deposit boxes. Bank safe deposit boxes are not insured by the FDIC. In a bank closure or forced bail-in, access to the building can be locked down entirely. Private non-bank vaults operate outside the financial network, giving you true physical custody. Fifth, leverage self-custodied digital assets. Technological innovation has created a brand new asset class with unique legal and structural properties. Bitcoin held in true self-custody using a private hardware wallet gives you direct mathematical ownership of a bearer asset. When you hold your own private cryptographic keys, no bank can execute a bail-in on your account. No centralized platform can alter your balance. No external entity can freeze your wallet without physical access to your private key recovery phrase. It allows you to hold globally mobile wealth completely detached from traditional banking risk. Sixth, shield your wealth with comprehensive umbrella liability insurance. Legal defense costs alone can destroy your life savings before a judge ever delivers a verdict. An umbrella insurance policy is one of the most cost-effective tools in all of personal finance. For a few $100s a year, an umbrella policy adds $1 to $5 million of extra liability protection above your standard home and auto policies. If an unexpected accident occurs on your property or on the road, your umbrella insurance covers the legal defense team and any potential court settlement. It prevents plaintiffs from seizing your personal brokerage accounts, bank balances, or real estate equity. Building a secure financial future requires constant vigilance and strategic execution. You must audit your financial footprint today. Take a piece of paper and write down every single asset you own. Look at where your cash sits. Is it concentrated in one vulnerable location? Look at your legal titles. Are your properties, investments, and businesses exposed to personal liability? Look at your yield. Is your money sitting idle in low-interest accounts while inflation eats away your purchasing power? Fix these vulnerabilities one by one. Move excess cash out of vulnerable savings accounts and into short-term treasury bills, high-yield money market funds, or physical assets. Set up proper legal entities and living trusts to protect your family legacy. Diversify your custody methods across cash, hard assets, real estate, and self-custodied digital holdings. When you execute this strategy, you take full control of your legal rights. You transform yourself from a helpless participant in a fragile banking system into a resilient investor with a fortified balance sheet. The legal system rewards those who know the rules and prepare in advance. Do not wait for a financial crisis or a frozen account to start building your defense. If this script gave you actionable insights to protect your wealth and understand your legal rights, hit the like button right now. Subscribe to the channel and turn on notifications so you never miss another deep dive into investing, asset protection, and personal finance secrets. Drop a comment below and let me know, what step are you taking first to secure your savings outside the traditional banking system? Let us start a conversation in the comments below.